This video presents a financial performance analysis of Alphabet Inc. for the third fiscal quarter of 2025. In the executive summary, we see that consolidated revenue grew 16% year-over-year to $102.3 billion. Google Cloud operating income increased 85% to $3.6 billion, demonstrating strong scaling. However, a $3.5 billion European Commission fine suppressed consolidated operating margins. Looking at revenue mix, Google Search and others showed 14.5% growth, reflecting a healthy pricing environment and resilient consumer demand. Google Cloud grew 33.5% to $15.2 billion, while YouTube ads grew 15%. Our operating margin analysis shows that the reported operating margin for Q3 2025 was 30.5%. It is important to note that this was suppressed by the €3.0 billion EC fine, but underlying profitability improved robustly when excluding this factor. Google Cloud is showing scaling profitability with $15.2 billion in revenue, accelerating 33.5% year-over-year. Operating income rose 85% to $3.6 billion, and the operating margin expanded to 23.7%, a gain of 660 basis points. The AI investment cycle is highlighted by year-to-date capital expenditures of $63.6 billion. This 66% year-over-year surge represents an aggressive move to secure market leadership in generative AI services. Management guidance implies a significant CapEx increase for 2026. Regarding capital allocation, $11.6 billion in shares were repurchased in Q3. Dividend payouts totaled $2.6 billion. Strategically, Alphabet agreed to acquire cloud security leader Wiz Inc. for $32 billion, expected to close in 2026. This table provides a financial breakdown by segment. Consolidated revenue reached over $102 billion, with 16.0% growth and an operating margin of 30.5%. Google Services remains the largest contributor to revenue and operating income. Alphabet faces increasing regulatory friction, with a $3.5 billion EC fine accrued in Q3 2025 related to ad tech practices. Ongoing U.S. antitrust cases regarding search and ad tech remain key watch points for investors. The risk monitoring dashboard highlights several challenges, including regulatory scrutiny, the risk of depreciating high-cost infrastructure before AI revenue scales, and M&A integration risks with the Wiz acquisition. In synthesis, Alphabet delivered strong, broad-based revenue growth, led by resilient advertising and continued momentum in Google Cloud. But reported results were weighed down by a $3.5 billion European regulatory fine, which compressed margins and masked the underlying operating strength. The bigger picture is two opposing forces. Alphabet is aggressively investing in AI and cloud infrastructure to secure long-term leadership, while at the same time facing intensifying global regulatory pressure that's now turning into real financial penalties. Core earnings power is improving, especially in cloud, but near-term margins will face pressure from rising AI capex and depreciation. Competitively, Alphabet is strengthening in future growth markets, even as regulation increasingly constrains its dominant advertising franchise.